Sponsored by Chartered Financial Strategies. You are now watching Tax Bites.
Welcome to another episode of Tax Bites, and today is that continuation of tax planning, the myths or the myth. And today's myth is that tax planning and tax preparation are separate, distinct entities or distinct processes, and one is a more valued process, such as tax planning. It's more robust and value beneficial to the client, and tax preparation is kind of that mundane thing you just kind of have to endure. And what I want to show you is they're really very much integrated and very important that one, meaning tax preparation and administrative efforts, have to happen and in conjunction with tax planning, or the tax plan will fail. And there's just three common tools I'm going to speak to, not all of them. And one of them is, like the trust, a business entity of some sort, a corporation, a partnership, an LLC, whatever, and some kind of retirement plan. These are three things you kind of put together and pull out of your toolbox, so to speak, to create a tax plan. And all of these have to have some kind of method by which you put assets in them. You'll title an asset or retitle an asset, as the case may be, into the trust. You form the trust, now you want to put real estate in it. You have to go and get it deeded into that. A business entity forms, and you have to, just like you have to deed the property to it, or a bank account has to be opened with it with money in it. You have to actually issue shares and go through some record keeping that stock shares or membership units in an LLC were issued, money was received for equity, and that's in the books and so forth. That's an asset. That's a retitling process. There's a funding process to put money into a retirement plan. It has to be put in by a certain time frame in a certain way and so forth for retirement monies to go into that retirement plan and be in that account and so forth and be utilized a certain way. So there's some kind of asset titling or funding process that has to occur for all three of these. You also have bookkeeping or record keeping of some sort. And yes, trusts do need record keeping. It's not always done, but a trust will have some expectation of how trust funds are being used, how is corpus being used versus income, how are things being distributed out, things of that nature. A business entity, just common sense as bookkeeping, you have to have income and expenses, assets and debts and so forth, and equity, and those things have to be tracked, and record keeping has to be done to make that entity be valid, as from any kind of a record keeping standpoint, and show that it's being treated properly. And the same thing with retirement plan, you have record keeping there. You'll have to track, who gets what shares, whose contributions went into one area, whose contributions are accounted for how, income growth, profit sharing allocation, whatever is being done in that plan. There's record keeping on who's a participant, who's not, who's valid to be a part of it, who's valid to get vesting, all that kind of stuff. There's a lot of record keeping that go in, even for a SEP, where you have maybe an employer with 2 or 3 employees, and he wants to contribute to his SEP, and the employees, who in the employees is a participant in that plan. If he's putting 20% of his salary into a SEP, he's got to put the similar amount for those employees who are participants that year. That's not necessarily record keeping by a pension company, but it is record keeping that has to be done, or it could be invalidated. The plan can be invalidated, or voided. You can have the same thing with tax returns. You have tax returns that must take the bookkeeping and the asset titling and so forth and prepare tax returns, both in a trust, a business entity, as well as retirement plans may have it for 5500s. Those all have to be done. You have some kind of administrative designation. A trustee is designated for administration of the trust. You have board meetings for a board of directors for many business entities, and you have administrative efforts for retirement plans as well. And all those have to be done to keep it together. And more importantly is that here's the strategic plan you expect to put in place, but the tax preparer is the one that signs the tax returns. And if you separate tax planning from tax preparation, the preparer's name is the one on the return. The preparer has to be the one who agrees with how the record keeping is kept, the paperwork flows. All that has to be agreed by the tax preparer who signs it. And if your tax planner is someone different, you put the client in the middle of a tax planner saying one thing and a tax preparer saying no. And this is what often happens: is the client gets frustrated because they're getting two different opinions because they've been separated. So they have to be integrated together. And quite honestly, when this doesn't happen, this is where a large portion of my tax representation work comes from, is failed tax planning. Tax plan wasn't invalid or sketchy or anything outrageous. It just wasn't followed administratively speaking. Returns didn't get filed, assets didn't get funded to the proper entities and so forth. So this is, the big myth is planning is separate from tax preparation, and it's not. So I hope that's something you learned today. Nice, a little quick tax bite today. As always, like, share, subscribe, comment, and have a good day.